Elite civil rights and plaintiffs' attorneys often operate with a massive financial blind spot. They maintain complete cognitive dominance over complex litigation, but leave the business structure of their own firm entirely exposed. This is the expertise trap. When highly trained professionals spend their days advising others and making high-stakes decisions, they experience severe decision fatigue when it comes to analyzing their own operational architecture. The mathematical penalty for this fatigue is severe. A solo law firm grossing $2 million a year in contingency fees can quietly bleed hundreds of thousands of dollars directly to the IRS. This happens because attorneys default to reactive tax compliance. They engage a CPA in April to calculate what they owe based on the operational mistakes they already made over the previous 12 months. Winning major settlements in the courtroom yields very little if the attorney commits financial malpractice on their own balance sheet. Tax compliance is a strictly reactive exercise. It is the act of accurately reporting your financial vulnerabilities to the government so they can collect their maximum legal share. On the left, standard compliance. $2 million drops into a basic bucket, and the tax code siphons away half. On the right, tax architecture. Revenue enters specifically designed containment reservoirs. Liability is contained, making your April return merely a receipt of victory. To build this level of structural alpha, we deploy 3 specific mechanisms: entity correction, extreme retirement sheltering, and contingency smoothing. Defeating massive tax liabilities requires occupying the financial battlefield and setting up impenetrable legal structures long before the revenue ever arrives. The automated machinery of federal tax collection is designed to extract maximum capital from unoptimized businesses. The most common and expensive structural error high-earning solo practitioners make is operating their firm as a default single-member LLC. To the IRS, a single-member LLC is a disregarded entity. The legal wall protecting the business from the owner simply does not exist for tax purposes, exposing every dollar of profit to ordinary income rates. Many attorneys attempt a legally invalid quick fix by filing Form 1065, treating their single-member firm as a partnership to avoid payroll taxes. The IRS actively flags this mismatch, creating severe, immediate audit risk. Let's calculate the penalty at $2 million net income. You pay 15.3% on the first $168,600, plus 2.9% Medicare on the remaining $1.8 million, and a 0.9% surcharge. This produces over $95,000 in self-employment tax leakage annually. The foundational fix is the S-Corporation election under Internal Revenue Code Section 1362. This legally decouples the individual from the taxpayer. Under an S-Corp structure, the attorney divides their identity into 2 distinct roles: a W-2 employee of the firm, and a corporate shareholder receiving profit distributions. Section 162 requires the owner to pay themselves reasonable compensation. For a top-tier civil rights attorney, a defensible W-2 salary is typically set around $200,000. By paying payroll taxes strictly on that $200,000 salary, the remaining $1.8 million flows completely free of self-employment tax, instantly generating over $68,000 in retained capital annually. Decades of high-stress litigation pass quickly. Without deliberate intervention, the capital generated during peak earning years disappears into standard living expenses and annual tax payments. A $2 million earner operating with zero retirement architecture is exposing 100% of their income to the absolute highest marginal tax brackets. Standard retail solutions like a SEP IRA or a basic solo 401k are mathematically insufficient here. They lack the capacity to shelter the cash flow of a peak earner. The required institutional-grade solution involves stacking a safe harbor 401k on top of a custom cash balance defined benefit plan. Watch deduction capacity scale against limits. The solo 401k provides modest shelter, capping around $76,000, but the cash balance plan scales with age. An attorney in their 50s can shelter over $400,000 annually. Governed by Section 412, a cash balance plan sets a specific target retirement benefit. An actuary then works backward to determine the massive annual employer contributions required to fund it. This architecture forces a dollar-for-dollar suppression of adjusted gross income, systematically converting tax liability into legally protected generational wealth. The highest stakes environment in the legal sector is plaintiffs' litigation, where elite attorneys secure massive civil rights and personal injury settlements. This creates a volatile cash flow pattern known as lumpy income topography. A firm experiences years of heavy overhead and zero revenue, immediately followed by multi-million-dollar windfalls. This chart tracks lumpy income. Year 1 is flat. Year 2 sees a $3 million spike, followed by another flat line. That spike forces income straight into the 37% tax bracket and triggers strict phase-out rules, instantly eliminating the 20% qualified business income deduction. The mechanism to neutralize this threat is the structured settlement fee deferral. This strategy is anchored in unshakable legal precedent, specifically the United States Tax Court ruling in Childs v. Commissioner. The Childs Doctrine establishes that an attorney can defer the receipt of contingency fees through a structured annuity without triggering constructive receipt or immediate taxation in the year of the settlement. Operationally, the attorney intercepts the fee agreement and directs the funds directly to a qualified assignment company, which then pays out the fee in steady installments over 5 to 10 years. The timing requirement is absolute. The deferral structure must be fully executed before the settlement is finalized and before the attorney has a legal right to receive the cash. Let's apply this to the chart. By executing a deferral, the $3 million spike flattens out into a steady, predictable curve of $300,000 a year across a decade, keeping the income safely below the highest tax brackets. By dictating the exact timing of their revenue, an attorney dictates their tax bracket. They replace a chaotic liquidity event with a decade of steady, highly efficient capital. Entity correction, retirement sheltering, and fee deferrals are powerful in isolation. Combined, they create a unified financial engine. This schematic shows a massive, raw contingency fee entering the completed architecture. First, the capital hits the fee deferral filter. The overwhelming lump sum is stretched out, entering as a manageable, steady stream of smaller blocks. Next, those blocks pass through the S-Corp gateway. Only a strict, calculated portion is diverted to cover payroll taxes, while the vast majority bypasses the self-employment tax entirely. Finally, the remaining capital drops into the cash balance plan vault, creating a massive deduction that leaves only a tiny fraction of the original settlement exposed to standard income rates. Executing this requires strict adherence to IRS deadlines. S-corporation elections must be filed within 75 days of the target effective date, and defined benefit plans must be established and funded before December 31st of the tax year. You do not defeat the IRS by engaging a CPA for compliance in April. True structural alpha is achieved by engineering your defenses early in January, rendering the eventual audit completely powerless.